Welcome to the program. My name is Marty Schenkman, and we have a great panel and a very interesting, timely program about planning for the Secure Act. And in particular, we're going to talk about some creative techniques to help gain what we have lost by the Secure Act. And before we get started, we're going to have a quick word from our two sponsors, and then I'm going to turn it over to Jonathan Blattmacher for the introduction. We're joined by Matt Blattmacher, who's going to address some of the really foundational economic or financial planning concepts that are critical to this planning, and Richard Fox, who's going to enlighten us about CRTs and related planning. And Jonathan is going to introduce us to QSST and a very creative possible application as a beneficiary of a retirement plan. First, Interactive Legal, Vanessa.
Thanks, Marty. Hi, everyone. This is Vanessa Kanega. I'm the President and Director of Content Development for Interactive Legal. I'd like to thank our panelists for presenting today's webinar. Interactive Legal is honored to be a sponsor of this webinar and others presented by Marty Schenkman and his fellow panelists. This one should be interesting as it discusses a very significant change in the law affecting estate planners. And at Interactive Legal, we can help you with many of the concepts, the documents and provisions you'll hear about today. If you'd like to learn more about us, please email the email address being on your screen there, or visit us at interactivelegal.com. Thank you.
Thank you, Vanessa. Our second sponsor is Peak Trust Company, and I'm going to turn it over to Matt Blattmacher to make a comment or two.
Again, thank you everyone for joining us here today. It's a pleasure to not only be on this panel, but also to be able to sponsor. As Vanessa said, we have a really timely and interesting topic today for discussion. And if you have clients who need someone to help administer these great plans once they're been created, Peak Trust Company might be able to help. And for any additional information, feel free to reach out to any Peak Trust Company team member, even including myself. You can visit us on the website, www.peaktrust.com, or email can also be found on this screen or on our website. Thank you again.
And the email is for Nicole King, who's one of the contacts at Peak Trust. You could certainly email Matt directly. Jonathan, you were going to introduce the topic since it's your baby.
Thank you, Marty. This is a tremendously interesting topic, and I am honored to have my nephew, Matt, who's a CFP and really knows a lot about the economics, and my dear friend and co-author, Richard Fox, who writes the leading text on tax matters relating to charitable giving, and my new best buddy in the world, Marty Schenkman. We rarely go a day without talking to each other. Well, Matt's going to start us off, and Matt's going to go through the importance of compounding and tax avoidance. And this isn't just for matters relating to the Secure Act. It deals with all financial planning, every bit of it, whether you're trying to build wealth, whether you're trying to avoid income tax, whether you're trying to avoid estate tax or generation skipping tax. The concepts that Matt is going to talk about are critical to understanding how we can wring more out of qualified plans and IRAs, notwithstanding the Secure Act. So Matt, please fill us in some.
Sure. Jonathan, thank you for the introduction. Just to set today's stage for really the more, interesting and important material that comes later, I wanted to highlight a couple of concepts that, again, really lay a foundation for what we're going to talk about today. And, start with a basic issue, that is that we all understand that long-term wealth and the long-term wealth creation centers around generating positive returns and minimizing taxes. The perfect storm is if we can get both of those at the same time. And so tax-free compounding is, said by many to be the most significant factor in successful financial planning. And of course, tax planning and estate planning, estate tax planning, are subsets of financial planning. And then, Jonathan, the next, we can advance to slide one. Right. So avoiding tax is the same as building wealth. Benjamin Franklin had a great quote of "a penny saved is a penny earned." And if we're unable to get kind of the coup de grace of tax-free compounding, what's the next best thing we might be able to get, which is the postponement of the tax. And so we'll talk a little bit more about the importance of postponing or minimizing tax as much as possible. And on this subject, it's important to note a couple of interesting things. So seeking to reduce or avoid the income tax really only makes sense to the extent that we can get a positive gain, positive return, and that return really needs to be more than de minimis. Again, if the asset doesn't grow, the minimization or the postponement of the tax doesn't really matter. And then the higher the return, the more important the reduction or the postponement of the tax becomes. This is a very important concept that, again, if you really had one thing to take away, this would be something to focus on through the rest of the materials. And then if we can achieve a minimization of tax and any sort of return, minimizing our risk and maximizing the consistency of those higher returns is critical. So Albert Einstein said many things. He's purported to have this first theorem that compounding is the most powerful force in the universe. And there's kind of a fun example to illustrate this theorem. So if my family had 2 descendants per generation, so that's 2 children, 4 grandchildren, 8 grandchildren, and your family had 3 descendants per generation, 3 children, 9 grandchildren, so on. In 20 generations, my family would have 1 million descendants. And in 20 generations, your family would have 3.5 billion. Again, the 3.5 billion would overwhelm the 1 million. This is kind of Darwin's, the basis of Darwin's theory. And to demonstrate this power of compounding, there's an interesting question that can be posed. And for those of you who've played this game before, you're probably a little wise to this logic. But the question is really, if we can advance one more, would you prefer to have a return of 5% compounded or 10% simple? And at first glance, we might say, oh, we'll just take the bigger numbers. But the real question or the real answer lies in the question of how much time do we have? And the next slides will illustrate the power of that compounding over time.
Don't forget Mr. Einstein.
And of course. So there's an interesting graphic to illustrate, the power of, or the rule of 72. And, if you do some simple math, you can really see how 1 or 2% difference in a return can make a significant change in how quickly that money will, according to the rule of 72, double. So if we look at this chart, we've got a couple of, lines that illustrate what our returns would be and our ultimate return would be over time for various rates. So the first that are illustrated here is 5% simple versus 5% compounding. And as you can see, it's really significant. With 5% simple over 40 years, we've got roughly, $300. And with 5% compounded, we've got $700. So over double in that amount of time. And if you add 10% simple into the equation, you get a really interesting graphic that starts to develop. And you can see that it basically splits the middle. Of course, 10% simple is better than 5% simple. But you can see basically past year 20, 5% compounded beats even double the amount in a simple rate of 10%. And then some really, extreme example is 10% compounded over 40 years. You can see how this curve really starts to go, very linear. And when you think, okay, we've got 10% compounded versus 5% compounded, simple answer might be we'll have roughly double the amount over 40 years. That's not true. 10% compounded gives us somewhere in the neighborhood of $4,500, which is over 8 times the amount, or nearly 8 times the amount we would get with 5% compounded. So again, a graphical illustration to show really that the importance of compounding, as we can see from this graph, time really does matter. If it's a short enough time frame, we just don't see the benefit. But as the timeline expands, In review, some important corollaries on compounding, that the longer the term, the greater the effect of the compounding. Again, as that graph showed us, in the short term, some of these rates really don't make that much of a difference, but over time, they are massive. And that the higher the rate of the annual return, the greater the relative increase in wealth from compounding, and the difference between that 5% versus 10%. And so, Albert Einstein, we don't know if he actually said this, but we'll claim that he did, that the hardest thing to understand in the world is the income tax. And so now that we understand or have illustrated the power of compounding and returns, it's interesting to look at some charts that show how income tax affects, or taxation affects these returns over time. This chart again shows the effects of 20% annual taxation over 20 years of time. And so at 5% annual return, we can see that we get a 17% reduction in taxes. If we jump to a 20% annual return, it jumps to 49%. And at a 30% return, it's a 61% reduction due to taxes. I mean, it's massive. We're talking, even though 30% return is extremely high, we're talking about a huge decrease in the wealth. And of course, as we all know, 20% tax rate is not uncommon. Here, this chart shows essentially the same thing, but at a 40% rate. You can see that the numbers are even more significant, going from 32% at 5% annual return to 86% on a 30% annual return. But here's maybe the most interesting chart that I have in my material today, which is the effects of these returns versus postponing the returns. You can see a 17% erosion with tax if we get taxed at the end, if we get to postpone the tax, versus a 12% erosion if it's taxed annually. That's a delta of 5%. And I think if somebody said right now, I can guarantee you a 5% return in the market, we'd all say that that was, something pretty reasonable. And if we jump to the extreme at a 30% annual return, it gets to 20% erosion if it's taxed once at the end, but it's 61% erosion of the total dollars if it's taxed repeated annually.
Let me break in here, Matt.
Yeah.
Matt, let me just break in here that just go back to his prior chart, if you would, Marty, and you'll see this difference between taxing at the end and taxing annually. And we're going to focus on that when it comes to qualified plans and IRA. So please keep that in mind, that if you can postpone the taxation, all other things being equal, you're going to be significantly better off than if you have to pay the tax annually. Now, that isn't always possible. Sometimes it is. And one of the factors when you postpone, you may be bunching the income into a shorter number of years, and therefore you may be pushing income into higher brackets. But bottom line, as Matt's charts show, if you possibly could postpone the taxation as opposed to paying it annually, you're going to be significantly wealthier at the end of the day.
Absolutely, great comment. As we talked about in the beginning, the best we could do is avoid the tax, minimize the tax. The second best is how can we postpone it or avoid it for as long as possible. So some observations we can gain from those charts: the higher the effective rate of tax, the greater the erosion to wealth. The higher the rate of return for any given tax rate, the more the return is eroded. And so Jonathan has this corollary that if, compounding is the most important thing, the income tax is the hardest thing to understand in life, and, tax-free compounding is one of the best things we can do, then the most important thing in financial planning must be the tax-free compounding of returns.
The relevance of all this to what we're going to talk about for the rest of the program is that the techniques, and we're going to cover primarily three, a BDIT, first, charitable remainder trust, and third, the possible use of a QSST. And we'll explain all of these in the context of how they may help with planning for retirement assets post-secure. But a client's initial reaction may be, oh, that's so costly, so complicated, and oh my, and the legal fees. But that's not the analysis that's the correct analysis. If you go back with the client, and if you can't do it, have the financial advisor, wealth advisor do it, and you show them the impact financially on the long term of deferring the tax, the cost of doing the planning, albeit it may be complicated, may pale by comparison to the benefits that we're going to be able to provide. So when we show you these techniques, this is the analysis that should be done to show the client, well, gee, even if it is X dollars to create this, look at the benefits you and your heirs are going to get over long periods of time. So, Matt, you want to just go through your last slide real quick, and then we'll go on?
Absolutely. So the conclusions I think we, just want the audience to walk away with as we talk about the bigger and better materials of this presentation are that high compounding returns and low taxation are key to building long-term wealth. The greater the return, the more important it is to have that compounding effect. Greater the return, the greater erosion we'll receive from taxation. And so ultimately we're going to look at which method is best to avoid or reduce tax. And of course, as we all know, that's always dependent on several variables. We've got some interesting techniques to talk about today to ultimately avoid or postpone that tax.
Okay, thank you, Matt. I'm going to give a little bit of background and very little about the Secure Act, because at this stage we assume everybody is familiar with the Secure Act. If you want more general background on the Secure Act, Jonathan and I and several colleagues did a program which you can find and download a webinar on shankmanlaw.com/webinars. It's also on the Interactive Legal website. It may even be on the Peak website after the Secure Act came out, which reviews all the changes that were made in great detail. So if we go a little quick, that's because we want to focus on the techniques that we're going to come to momentarily. So the Secure Act, as we all know, eliminated the ability of most beneficiaries to be able to take distributions over the beneficiary's life. That's a stretch, a long stretch that had been really the magic elixir of retirement planning for so many years. Now, if the beneficiary is a DB, designated beneficiary, flesh and blood human being, or a conduit trust for a beneficiary, or an accumulation trust, the distributions can be taken at the end of the 10th calendar year after death. This is the so-called 10-year rule that was enacted as part of the Secure Act. The new default rule, and there's obviously some very important exceptions, but the new default rule, which is what much of the planning we're going to talk about is targeted at addressing, is that in the end of the 10th year following the death of the plan holder, the IRA holder, for example, all of the money must be taken out. You can wait to the end of that 10th year. You can take it out earlier. We'll briefly mention that. But the key point is the long stretch over the beneficiary's lifetime. A grandchild that can take it out over 50, 60 years in general is gone. So if the beneficiary is not a DB, not a designated beneficiary, just as under prior law, this hasn't changed, you have to take the distributions out by the end of the 5th calendar year following the death of the participant. There's one notable exception. This was under prior law. Everybody should mute. I'm hearing a little bit of background noise. That if the plan holder had died after their reaching their required beginning date, the RBD, that you have this so-called ghost life expectancy. In other words, you take it out over the remaining life expectancy of the plan participant. So certainly it could be a bit better than the 10-year period, certainly better than the 5-year period. But in general, that's what we have. Now, there's a new category that the Secure Act created, brand new category, did not exist before, EDBs, or eligible designated beneficiaries, EDBs. And EDBs are given some more leniency in terms of the time period over which they can withdraw funds, so that they're not assuredly subject to that 10-year maximum period we just talked about. Now, the primary EDB is the surviving spouse. So if it's the surviving spouse of the plan holder, the plan participant, the surviving spouse can take the distributions out over the surviving spouse's life expectancy. So in many cases, if there's a surviving spouse, and we'll address some of the trust planning as we go, you may just simply have the surviving spouse as the primary beneficiary, and they'll pull it out over their life expectancy, which gives a great deferral. There's a special rule for minor children of the participant. This is not for minors generally. It's only a minor child of the participant. Does not apply to grandchildren. A minor child of the plan holder is allowed to take the distributions out over their life expectancy until they reach age 18, or the age of majority could be 21, and there may be some twists on that. And then after they hit majority, they're now subject to the 10-year rule. So if a very young beneficiary, child beneficiary inherits, they get up until 18 or 21 and then 10 years. There's special rules for a disabled or chronically ill person. Be very careful. The definitions are very rigid, and many people that are struggling in significant ways may not qualify as disabled or chronically ill. The code definitions are unfortunately very, very rigid. The disabled or chronically ill beneficiary can receive these funds in an accumulation trust, which normally would be subject to the 10-year rule, but in their case, there's a special rule where a disabled or chronically ill beneficiary can pull it out over life expectancy through an accumulation trust. There's a final category of EDBs, which is a person not more than 10 years younger than the plan participant, but that's not going to come up very often. It may be, for example, a sibling if they're named beneficiary. And the final point on this slide just notes how incredibly high the combined income and estate tax bite can be on plan benefits, and that's exactly why we're going to focus on the three techniques that we're going to talk about in a few minutes. And keep in mind, we all anticipate that tax rates of all types and stripes are likely to be increased, certainly if a Democrat wins, but it would seem that they would have to be increased regardless of what the outcome of the November election is, simply in order to contribute to pay towards the massive bailouts that the government has been undertaking because of the COVID pandemic. Now, trusts are the default answer, I think, in everybody's view on this panel, because trusts can provide asset protection, trusts can provide asset management, trust can serve to prevent the wasteful disposition of wealth. We've all seen plenty of beneficiaries that are less than prudent, and it can perhaps avoid the loss of governmental benefits such as Medicaid, or for someone that's a special needs beneficiary. Trusts and IRA plans are complicated, and we're going to talk briefly about that. But the key is, what can we do to both secure the benefits, and we're not going to belabor it. We assume everyone on the call is drinking the Kool-Aid of trusts are the way to go because of all the myriad of benefits that you all know they provide. But the complications are, what do you do about the combined difficulties, complexities, tax complexities of mixing trusts with plan benefits? And the problem is, which we're going to talk about in a second, trusts are subjected to an incredibly compressed income tax rate that becomes a challenging part of the planning. Going back and remembering all the things that Matt said about deferring tax and lowering tax, you certainly don't want taxes assessed at a much higher rate on more of the income, and that's what trusts can do. So a conduit trust permits the life expectancy payout to be used for an electing designated beneficiary. For minor, it's only partial, as I explained, because once they hit majority, it's 10 years. But the good news about a use of a conduit trust is that it gets taxed, the income, at an individual tax rate, and I'll show the numbers in a few minutes, and not at the compressed, very high trust tax rate. The bad news is that the conduit trust, by definition, must pay out whatever it receives from the plan immediately to the beneficiary, so there can be no protection for those funds immediately paid out, and that could also create a problem for Medicaid or a special needs beneficiary. So good news on conduit trust is you can avoid the compressed trust tax rate. Bad news is you're losing a lot of the basic protections of a trust. Now, an accumulation trust, which as its name says, can accumulate funds and not necessarily pay them out to the beneficiary until it's appropriate. For a disabled or chronically ill beneficiary, as I said earlier, they can get a life expectancy payout. Nobody else can. Now, the good news for an accumulation trust is the distributions can be accumulated for creditor protection and government benefit protection. And really, one of the most important reasons, which is not here, but you all know, is to protect a imprudent beneficiary from dissipating assets. So accumulation trusts are a great answer for that. The bad news is, with an accumulation trust, we have trust compressed tax rates. And think of that in the context. If in year 10 the entire plan is paid out, the entirety of that is taxed to the trust if it's not distributed out of the trust, and the entirety of the plan amount after the end of year 10 following the death of the plan holder is subjected to these compressed tax rates. So the overall tax burden could be very substantial, and that's something we're going to try to give you some options to address. I'm going to do this very quickly on the next slide because I think you're all kind of familiar with it, but I think it's helpful to just show some of the numbers and how dramatic they can be. And this all plays back to what Matt was explaining about tax deferral and lower tax rates. Trust hit the top 37% tax rate at a bit under $13,000. That number's inflation adjusted. It changes every year. That's give or take about 13 grand right now. Standard deduction is too small to even warrant saying. But compare that to an individual, and this is why in many cases you better off getting the plan assets out to an individual. Individuals don't hit that 37% tax bracket until a $500,000 plus of income. There's a huge difference in the tax rates applicable to income in a trust versus an individual. And the bottom of this slide has some different tax rates just to show you how substantial it can be. Just for one quick illustration, a single individual would pay about 41 grand on 200,000 of income, whereas a trust would be $72,000, nearly double. Now, think again, keep Matt's charts in your mind. You stretch this out over 20, 30 years, and you have a double tax cost differential. The impact overall is going to be massively negative. So you got to be careful to help clients plan for the use of trust. So to just summarize, we want to use trust because we don't want beneficiaries to dissipate assets. We don't want to put assets at risk to creditors and claimants, but we got to monitor this tax cost, because as Matt explained, over the long term, this is the single biggest determinant factor of wealth with the return. Now, designated beneficiaries can postpone receipts until the end of the 10th calendar year following death, after the end of the 10th year following the death of the plan holder. But if they do that, they're bunching all the income into that 10th year. So it might be better, and you really have to crunch the numbers and look at the assumptions, and all this might depend on what the tax rates are in the future, and those may continue to change, probably will. It may be better in some cases to take it out in slices over the 10 years and a piece at the end of the 10th year, rather than bunching it all at the end of the 10th year, depending on the amounts involved and the tax rates. You got to crunch the numbers to really know. An eligible, get to the names, the acronyms. We have lots of acronyms. The eligible designated beneficiary or a conduit trust for an EDB can take annual payments out over his or her life expectancy, like a surviving spouse, a chronically ill or disabled beneficiary, somebody 10 years younger, beginning the year after the participant died. But the life expectancy annual payouts for a minor, again, it only goes until majority, 1821, and then the 10-year rule kicks in. So we can use a trust, a conduit, for selected eligible designated beneficiaries, EDBs. One of the questions, and Jonathan, if you want to jump in, feel free to. One of the questions is, when you have a minor as a beneficiary and the conduit trust has to make a distribution, what do you do with the money that's going out to a minor? Because the law for a conduit trust says it has to go to the beneficiary. A custodial account is not clearly, assuredly, the beneficiary. So do you give it to the minor? Jonathan, you want to comment on that?
Well, I don't think you can give it to the minor, because the minor doesn't have the capacity to receive property. Now, the last thing you want, at least whenever I've had them, is to have to use a guardian of the property. You will wind up in court. You'll be frustrated on investments. You'll be frustrated on expenditures. So the question is, what do you do? We're hoping that the Treasury will agree that you can make distributions to a custodian under the Uniform Transfers or Uniform Minors Act, and we hope they'll come out that way. Keep in mind that in many states, you can't make a distribution to a custodian if the property is supposed to go to a minor. And here you have a question. Suppose you want to use a conduit trust for a minor because you want it taxed at the minor's rates. You don't want it taxed at the trust rates. And you are required, in order to have a conduit trust, that the distribution must be made immediately to the minor. How can you do it? Well, under the law of all states, if it's paid to a trust first, and the conduit trust, of course, is a trust, you can pay it over to a custodian whom the trustee will select. We're hoping that the IRS will agree that if you pay it over to a custodian, that will be treated as though you're paying it over to the minor beneficiary. That makes an awful lot of sense. And keep in mind that before the Secure Act, we didn't face this problem because you could have it go into another kind of trust for the minor. So we're hoping that they will do that. But that's something that we've got to consider. Now, on non-conduit, non-accumulation trust, it means that they're going to have to withdraw it all in 5 years. Remember, if you're not a designated beneficiary, in other words, a two-legged human being, and you're not a designated, not a conduit trust, but you're an accumulation trust, then you're going to be facing a 5-year regime unless you fall under the accumulation trust things. And the only time you can use an accumulation trust and get more than a 5-year payout is with respect to a chronically ill or disabled person. You can't do it for the surviving spouse. And that seems contrary to what Marty said. Marty said, no, if it's a surviving spouse, you can pay it over his or her life expectancy. Well, that's only true if it's directly to the spouse or to a conduit trust. If it's to an accumulation trust for the spouse, you're going to be stuck with 5 years. So that's a really serious problem. Now, some say the Treasury has to change that so you can do a conduit trust an accumulation trust for a spouse. But that's not the way the code literally reads. But maybe the service, will take a little bit of help us just a little bit by allowing accumulation trust for a surviving spouse.
Thank you, Jonathan. Let's go on. Now, I'm going to turn it over to Richard, who is going to tackle one of the first of the 3 planning techniques that we're going to talk about to deal with all the issues that Matt laid the groundwork for and I gave you a little background on. We're going to talk about charitable remainder trust, lots of variations of those. We have 3 examples at the end that Jonathan and Richard, or some combination thereof, will go through. We're going to talk about grantor, BDIT beneficiary, deemed owner trusts. And finally, Jonathan is going to introduce the latest of his many brainchilds. The QSST is a receptacle for retirement plan beneficiaries. And I'm not sure what acronyms he's going to use, but I'm sure there'll be a tongue twister. So Richard, it's all yours. Richard, did we lose you?
He seems to be frozen.
Good. I'm here. Can you hear me?
Yeah, we hear you fine, Richard.
Can you see me?
Don't worry about that.
No, you're frozen. Your picture's frozen, but hearing your voice is good enough.
Let's just go forward. Just talk. Just talk, Richard.
Okay. Yeah. So charitable remainder trusts offer a really unique technique to deal with the Secure Act and the limitation under the Secure Act that unless you're a eligible designated beneficiary, you have to receive your payments within 10 years. Granted, you don't have to receive it until the end of 10 years, but you have to receive it, and that's going to be a taxable event. So I've used charitable remainder trusts many times to receive qualified payments, IRAs, 401ks, and they work very well. And in those situations, it's really for not so much for tax or economics, but it's a way to, spread out the funds among various, beneficiaries. So I think with the Secure Act, the limitation, the do away with the stretch IRA, that the CRT has renewed life, even though it's always been a good planning tool, but a renewed life in the context of the Secure Act, because a charitable remainder trust can receive payments from a plan or an IRA, and as everybody knows, a charitable remainder trust is a tax-exempt entity under 664. So anything other than unrelated trade or business income that a CRT receives is tax-free. That's the beauty of a charitable remainder trust. And then, of course, distributions that flow out to beneficiaries carry out income. And it's the worst in, first out rules you're probably all familiar with, so that the highest tax income flows out first. Just want to say, there are various tests that we don't really have to get into, but just be aware that, as you probably all know, these CRTs are subject of statutes and subject to regulations. They're much more regulated than charitable lead annuity trust or charitable lead trust. So there are a lot of rules, potential footfalls you can run into. So you really have to make sure you set these up accordingly. And as we say in the outline, there's generally, three types of trusts for a CRT: an annuity trust, a unit trust, and an income-only trust. The most popular income-only trust is what's known as a NIMCRUT. So that pays out the lesser of the fiduciary accounting income or the percentage payable, because unlike a charitable remainder annuity trust, which pays out a flat dollar amount annuity, a CRUT pays out a percentage. So if the value of the trust assets goes up over time, the percentage applied to a greater value is a greater distribution. And that's one of the things that this helps keep up with inflation, as opposed to a CRAT, which really doesn't, because if the assets go up, the non-charitable beneficiaries don't derive any benefit. And there are, as you point out, as you're probably all familiar with, there's rules for probability of exhaustion test, a 10% minimum value charitable requirement, because they want to make sure that there's some money. This is really a philanthropic tool. It's a split interest trust, and they want to make sure that this is indeed set up to provide some benefit to a charity at the end of the day, and that's why it's an exempt entity, because ultimately the charity gets the funds. So that's something to definitely keep in mind. So as I said, the bad news as far as distributions are concerned is that the charitable remainder trust is not a designated beneficiary. So the payments have to be made within 5 years. But is that bad? Well, not really, because when you transfer the funds to the CRT, it's not subject to tax. So hey, make a distribution to us. Hey, maybe we don't want it within 5 years otherwise, but it doesn't matter because it's tax free. So that's the good news, that the receipt of the funds by the CRT are tax exempt. And as Jonathan always says, that this 10% payout to the charitable remainder beneficiary, it's almost like you're paying rent for the ability to have a tax-free CRT during the life of the CRT. And I think Jonathan would agree. He's always told me this, that he's never written a CRT where the remainder interest to a charity is more than 10%, which is the minimum. And the theory is that not so much that we want to cut out the charity and just pay the limited 10%, but there are other ways, generally speaking, where you can get charitable funds to a charity you want to support other than with the CRT. So we typically keep it at 10%. So that's kind of the general rules for the charitable remainder trust. We get into the charitable remainder annuity trust. As I said, it's a flat fee, a flat amount. It has to be at least 5% of the initial fair market value, and after that, it's an annuity. So it can hit a grand slam in investments. The charitable beneficiaries get the same thing. And the downside of the charitable remainder trust is that these work best in a high interest rate environment. And we are now in an extremely low interest rate environment. And because of this low interest rate environment, where it assumes that the assets are going to grow at a very limited, small amount based upon, let's say, the June interest rate, the 75-20 rate is 0.6%, it assumes that's all it's going to make. So it's very difficult to meet the 10% remainder interest requirement. And there's also a 5% probability of exhaustion rule for charitable remainder annuity trusts that pay for a lifetime, not for a term. And it's just so incredibly hard these days with the June interest rate of 0.6%. It's virtually impossible to meet these to meet the requirements to do a CRT. So as we say, don't plan, at least in a testamentary trust, don't plan on doing a death time CRT for the life of a beneficiary. There are ways where you could use a formula clause for a term where you say, I'm leaving this to this child remainder trust. Distribution shall be based upon this, and the term of the trust shall be equal to that term, which will cause the 10% remainder interest requirement to be met. But it could be that the term would be 3 years. So it's a little risky doing that. So unlike the CRT, a CRT is not sensitive to any extent, for the most part, a very, very limited extent, but I would say to any extent, generally speaking, to interest rates. And as you point out, unit trust payments will decline if the value of the trust goes down, but if the value of the trust goes up, you share in the distribution.
Richard, this
yes.
is Jonathan. Let me mention one thing that may not be obvious to everyone. When you use a charitable remainder uni trust, the Section 7520 rate, which Richard points out in June, will be 0.6%, and I think it will be 0.4% in July. That's just amazing. But if you're doing a uni trust, the uni trust is not very sensitive to that Section 7520 rate. And so, for example, whether the Section 7520 rate is 0.6 or whether it's 16, you can do a 20-year charitable remainder uni trust to pay an 11% uni trust amount for 20 years. I mean, that's just remarkable. So you might say, well, gee, how can we make this work? Well, you can retain the right to receive 11% a year for 20 years. And one of the nice things about having a fixed term as opposed to life is you can specify that it's discretionary as to who will get it. So you could have all of your descendants, you could have a non-charitable remainder trust, just a regular trust is one of the beneficiaries of that. The trustee can allocate distributions of the uni trust amount in any way that the trustee wants in that. So that's a very good deal.
That's exactly, and it's all function of interest rates not having, for the most part, any effect on these calculations for a charitable remainder unit trust. So that's a great point. And as we point out in the last bullet point, that the trusts work especially well when you have taxable income within the trust, which is not subject to tax, but that exceeds the amount that you're paying out to the beneficiaries, because that goes to that whole compounding. Because to the extent you don't distribute out income to the beneficiaries, the non-charitable beneficiaries, all those funds are staying in the trust without paying tax, and they're going to be invested and compound and compound and compound and grow. So that's pretty good, which gets us to this interesting point where you could have, as I said, a NIM CRT. You can pay out the lesser of the fiduciary accounting income or the percentage. Congress never allowed that for a CRT for some reason. They only allow it for CRTs. So if you're thinking about some type of NI CRT, don't think about it because you can't do it. So this is really fascinating because, and I've done this before, and the IRS has put out some notices on this, but I've done this with some child remainder trusts where the trustee, and this was a national trust company, they were the CRT trustee. They took all of the assets, transferred it into a partnership, and the partnership was controlled not by the trustee, not by the beneficiary, not by the grantor. So it was subject to independent control. And under state law, the only time a CRT is going to have fiduciary accounting income is when the partnership makes distributions. So you could have a situation where the partnership decides, I'm not going to make distributions to the CRT. Now, the CRT will get a K-1 showing taxable income, but But no worries. The CRT files a 5227. It reports it, but it's tax-free. It doesn't pay any tax. So theoretically, of course, these things should be considered. Theoretically, and these things, I don't know, Jonathan, if you call them spigot trust. I always call them spigot trust because maybe I shouldn't use that word, but the partnership can turn a spigot because under state law, distributions from the partnership, regardless of what they are, they just say distributions from a partnership are considered to be fiduciary accounting income. So let's say year after year after year, the partnership doesn't turn on the spigot, and all this income is taxed to the CRT, but nothing goes to the beneficiaries. But because it's a NIMCRUT, there's a provision that says to the extent the benefit, the fiduciary, the amount distributed to the beneficiary, let's say it's 5%. If it's limited because the fiduciary income is less, because it's a lesser fiduciary accounting income or the percentage, then it doesn't get paid out because it's a lesser of. But if it's a NIMCRUT, not a NICRUT, where there's a makeup provision, you keep track of the deficiency, and when you do have a hit with a big amount of income, then the trustee has the discretion to allocate that big hit of income to the income beneficiary, to the remainder, to the unitrust beneficiary. And it can say, well, we haven't paid you $100,000 or $200,000 in your distributions because it was limited to the lesser of the accounting income or a percentage. And because it was limited, because something was paid out, we now owe you this deficiency. But now the partnership has decided to make this big distribution, and you've got a boatload of income, and we could use that income because the fiduciary accounting income in that year exceeds the unitrust amount, and we can make a huge distribution to you. So the whole point is that you could have year after year after year where the spigot isn't turned, you're not getting distributions, therefore there's no tax that's coming out to the non-travel beneficiaries. So you get this compounding. It's compounding, it's compounding, it's compounding, it's compounding beyond 10 years, like it would under the Secure Act for an IRA, and then bam, you make that distribution later on, and that's you have a deferral and compounding, and ultimately when you make the distribution, it will be subject to tax, but it's at that point it's subject to a lot of compounding and a lot of avoidance of tax on those because the CRT is an exempt trust and none of it was distributed out. So it really offers quite a benefit if you can set up the spigot trust correctly. As we know, there's a Revenue Procedure 9273, which talks about when the IRS will respect the spigot trust. Basically it has to be controlled by some third party, and if you're able to overcome those requirements, you can basically turn on and off the spigot to create fiduciary accounting income, and that is a real that is huge. That is huge in this world where, as Matt said, compounding without paying taxes. So this thing could be built up so much more than what a 10-year Secure Act payment would be. It's just incredible what the difference could be.
Marty, do we have an example of that? Well, Richard, why don't you go through these points if you would?
Which points?
Well, these next points. Consider what you have to do. Are people better off with a CRT? And the bottom line is the value of the remainder which you have to give to charity. I'm going to assume that the family has absolutely no charitable interest. It just wants to maximize what their descendants get. What do you pay for that? Well, you're going to have to give 10% of the present value to charity. And the question is getting that longer stretch, which can be 20 years easily. In fact, if you've got someone relatively young, it could be over their lifetime. It could be 30 or 40 years. Is it worth getting that additional period of tax-free compounding worth the price of giving the remainder to charity? So that's really the question that you have to come up with. You can do an Excel. Go ahead, Richard.
Right. And we've done some examples which we can share, but where a 10-year, where an IRA receives the full payment in the 10th year, pays tax, and then it takes that fund net of tax and invests it for another 20 years, and then compared that to what's left over what will be paid to a non-charitable beneficiary after 20 years, when during those 20 years the funds are held in a partnership and not distributed out until the 20th year, and the difference is pretty remarkable. It's the bottom line is it's the funds in the CRT really totally outweigh what's left over when compared to the person receiving a 10-year distribution, a distribution after 10 years, paying tax, and then investing that fund net of tax for another 10 years, and comparing it to what the CRT has available to pay to the non-charitable beneficiary after 20 years without paying any tax. It's quite a remarkable difference when you go through the numbers.
Everyone should just keep in mind this is precisely what Matt illustrated in the beginning of our program, because the deferral with the Secure Act is max 10 years, because at the end of the 10th year following death, you have to pay it out and pay tax. Whereas under the approach that Richard is suggesting with a NIMCRUT, you greatly can extend that deferral period. All goes back to the basics that Matt was illustrating. Jonathan, how about walking us through? We have two examples. This one, just so you know, goes on to the next page.
Yeah, well, this is just an illustration of it, and it really depends upon what happens. Like if you have $1 million IRA, and you could pay it to a NIMCRUT to pay the lesser of fiduciary counting income, or 11% for 20 years. And if you assume that IRA is going to grow at 6% a year, and no unit trust payments are made because there's no fiduciary accounting income, it's going to be worth $3.2 million at the end of the 20 years. And again, this shows the power of compounding. $1 million has grown to $3.2 million at just 6% a year for 20 years. And then you can take it out, and you're going to wind up, let's go to the next page if you want, Marty. And everybody watching, you can run your own numbers, but the bottom line is that you may get considerably more at the end of the day by keeping everything in the CRT until the end of the 20th year. The higher the return you get, the better the CRT will look. So I use 6%. And by the way, if you have an advisor who doesn't think that they can get 6% a year on average over 20 years, you know what you should do? Hire a new advisor. If you take a look at the Ibison charts, it will show you that on average, stocks produce about 10% a year. In fact, if you take a look at any 5-year period, beginning with the Great Depression, any 5-year period, you will see that the returns, if you go into the S&P 500 or the equivalent, will be substantially greater than 6% a year. And this all brings us back that a CRT, a NIMCRUT, may be one of the best ways you can do it if people can afford to wait and they're trying to maximize wealth. And of course, one thing is, if the family decides we've got plenty of money, we don't need this, you can just leave it all in till the end for charity. Let's go to our next slide, Marty. And this is just how do you do it. You can have the IRA paid, as Richard indicated, and then have the NIMCRUT pay it over to a partnership or an LLC, so you have no fiduciary accounting income. Or you could make it payable to the LLC or partnership that's owned by the charitable remainder trust, and you'll still get the estate tax deduction. And when you take into account the fact that you're going to get an estate tax deduction if the estate is large enough, the cost isn't 10%, it drops down. It drops down to about 6.5% rather than 10%. So the price you're paying for this long-term exemption from taxation is not even as expensive as we indicated at the beginning, which would be 10%. If you're subject to estate tax, it's going to be in the range of about 6.5%. Marty, tell us about BDITs.
Sure.
Oh, one thing. Oh, I forgot to mention. Someone wrote to me and said, Jonathan, I read the article by you and Richard and Matt that was in the May issue of Estate Planning Magazine. It was really great. But what I want to know is, can I have the IRA payable to a charitable remainder trust? Say my family is going to get a uni trust interest. Can they turn around and sell that uni trust interest or annuity interest and have it treated as long-term capital gain? Boy, wouldn't that be good? It's paid in there, I delay, I sell it, I get long-term capital gain, not ordinary income. What a super deal. Well, that's indicated that you can do that in Revenue Ruling 72-243, but there's something known as the substitution of ordinary income doctrine. And if you see that case, Latera there, this is the case where someone won a lottery and was going to get a lot of money, but it's all ordinary income when you get it from a lottery. So they said, I'm going to sell it, and that way I'll get long-term capital gain. Well, the Latera case said, no, you can't. You can't turn all receipts that would be ordinary income into long-term capital gain. So you may not be able to do it. One of my co-authors, Lad Boyle, is coming out with an article in which they say that you can sell an interest in a regular trust and get long-term capital gain treatment. Lad feels very strongly about that. But my dear friend Mitchell Gans is a little concerned about the substitution of ordinary income doctrine. So I must say this would be terrific if you can do it, but I think you have to view it as an aggressive strategy. Let's go on, Marty, if we could.
Okay. So that was, let me just summarize for everybody. We started with sort of a foundation that Matt Blattmacher created on the benefits of deferring tax, how much better it is to pay tax at the end of a period than each year during the period, and compounding. We then gave a quick overview of the Secure Act and what it's done to make it so much harder to defer tax on retirement benefits. And then Richard gave a great discussion of how you may be able to use CRTs, charitable remainder trust, and in particular net income with a makeup provision, CRUT, CRUTs, NIM CRUTs, in order to defer for a very long period of time the income tax on benefits of a plan by paying it into this NIM CRUT. So that was one of three techniques. I'm going to take a few minutes and give you another possible technique, and then I'm going to turn it over to Jonathan, who has a new creative technique that, if I'm remembering correctly, you just created this now. This has not really ever been done before, right? So, and that's going to be the twist. So let's talk about the second of the three techniques that we're covering for dealing with these issues of how the Secure Act has adversely affected the income taxation of retirement plan assets. So is there yet another approach that might be used? And perhaps there's an approach where you could create a structure where the trust is not taxed itself on the retirement plan income, but rather a beneficiary of the trust is deemed to be the owner of the trust, BDIT, beneficiary deemed owner trust, a 678 trust, and that beneficiary would then therefore have to report the income from the plan instead of the trust reporting it. And why is that potentially beneficial? Remember when I gave the quick overview of what the Secure Act has done, I showed you the tax rates that apply to an individual is contrasted to a trust. So if a trust is in the maximum tax bracket because of the compressed rates of tax that are applicable to trust at about $13,000, but an individual has to get close to $500,000 or more than $500,000 in that neighborhood before they hit the maximum tax bracket, you can see the potential for significant income tax savings by having the beneficiary, not the trust, taxed on the retirement plan assets. And as Matt demonstrated, that lower tax, again, when compounded, is the key to wealth. So let's take a look at the couple of slides that we have here. So you want to consider, as we said earlier, trust, because trust can accomplish a range of important non-tax goals, such as protecting assets, maintaining qualification for government benefits, special need benefits, Medicaid benefits, protecting trust assets from a imprudent beneficiary, and so on. But the negative of a trust, as we explained, was the high tax brackets, the compressed income tax rates. So how might a 678 trust, a BDIT, BDOT help? BDOT is that if we give the beneficiary the right to withdraw all the assets out of the trust, the income of the trust will be taxed to the beneficiary, even if the beneficiary does not pull those assets out. So giving that right to the beneficiary will cause the income of the trust to be taxed to the beneficiary without the beneficiary even having to take the funds. So that's the concept. Now, one of the problems of this is we suggested that one of the reasons you want to use the trust in the first place is asset protection. And the problem potentially is that if the beneficiary has the right to pull out all the assets of the trust, have you not negated the asset protection? And there's a couple of points there. Some states, and we mentioned two here, but there may be others, Alaska and South Carolina, will not subject the assets of the trust to the creditor, the reach of the beneficiary's creditors, because the beneficiary has a right that's unexercised to pull those assets out. If a withdrawal power is partially released or modified, that may, I lost my thought. But the point is, if the beneficiary can release the power to withdraw all of the income and principal, but retain a HEMS power, it should still be arguably a grant or trust. That was a private letter ruling that Jonathan got for a BDIT, a beneficiary defective irrevocable trust. Now, we talked about the second to last bullet point, how a accumulation trust can be used for a disabled or chronically ill beneficiary and still secure the lifetime payout. But that won't work for anybody else. A lifetime accumulation trust will not work for a surviving spouse or a minor. So I guess the issue is, what do we do to get things taxed at the lower rate? And the answer is to have the beneficiary pull it out. Now, another possible issue is there's different views on whether, if you have a BDOT, this beneficiary deemed owner trust, if you have to give the beneficiary the right to pull out all the principal, or whether you can achieve that grantor trust status by virtue of giving just a right to pull out the income. Ed Morrow, I believe, wrote an article suggesting, and Jonathan, you may want to comment, that if you give the beneficiary the right to pull out the income, that may suffice for purposes of creating a grantor trust, and nonetheless then would protect the principal, because the beneficiary is not getting the right to pull out the principal. You may not want to use that type of technique or rely on that type of approach if you're trying to do a much larger transaction, such as a note sale to a grantor trust. But in the context here of having that trust be the receptacle for retirement assets and having the income be taxed to the beneficiary, that may suffice. Could everybody mute if you're not on? If you're not speaking, we should all mute. Jonathan, did you want to make some comments on the beneficiary deemed owner trust, the grantor trust approach?
Yeah, let me say that there's no real distinction here about whether you're saying a beneficiary can pull out all the tax income or can pull it all out, including the principal, because the IRA is all going to be taxable income. Right. I'm assuming you're not going to make the Roth payable to it, so it's kind of an irrelevancy. And the IRS Treasury will be asked to confirm that if you name a trust, which is a 678 trust with respect to an individual, that individual will be treated as the beneficiary for qualified plan and IRA purposes. So this, number one, could provide good management, as indicated by the private letter ruling 2009-44002. You can have the beneficiary have the right to unilaterally withdraw it all, including the corpus, lapse, and retain a HEMS power to withdraw, and under the law of even more states, including New York, that will not subject the assets any longer to the claims of creditors. The one thing you probably will get if the beneficiary loses that right, you're still going to face probably 5 years of ineligibility for government benefits such as Medicaid. And
Okay.
Marty, let's now go on to the final chapter here.
This is
the
exciting part of the whole, most exciting part.
Yeah, the crazy idea I had, because remember what I'm trying to do is I admit I am the most pro-trust lawyer in the world. And I want stuff in trust for all the reasons that Marty gave several minutes ago. But I don't want to tax at the trust rates. So it finally struck me that maybe what I should do is name an S corporation as the beneficiary of my IRA or qualified plan interest if the shareholder of that S corporation is a qualified subchapter S trust who's their QSST. Now, as you know, only two-legged individuals who are American taxpayers and a certain limited number of trusts can be shareholders in an S corp. And of course, the income of an S corp is taxed to the shareholders as though they received it directly. So I now make my qualified plan or IRA payable to an S corp. The income of that S corp is going to be taxed to the beneficiary of the QSST, because the QSST, the qualified subchapter S trust, is going to be the shareholder of the S corp. So the IRA payments or qualified plan payments are paid to the S corp, but the S corp now won't pay tax on it. The beneficiary of the trust will. And by the way, that income is taxed to the beneficiary even if the beneficiary doesn't receive anything. A QSST must distribute its fiduciary accounting income, as determined under state law in the terms of the governing instrument, to the beneficiary, but you don't have to make a distribution from the S corp over to it. So that way, it can all remain in the trust. You don't lose eligibility for government benefits. You're not going to be subjecting the IRA to or the interest in that trust to the claims of creditors of the beneficiary, because you're going to make it a spendthrift trust. So you really got it good there. The bad news is that you have to pay it out probably within 5 years. There's an argument that maybe 10 years should apply. I don't think so. I think the IRS is going to say, nope, you get it. You're going to have to pay it out over 5 years. Now, an S corp doesn't need a business purpose, so you don't have to worry about that. The IRS will come in and say you only did this to save taxes. Yes, I did, but there's nothing wrong with that. And it's not subject to the personal holding company or the accumulated earnings taxes either. So that means you can do it. Now, one good thing, the beneficiary is going to be taxed on this income. Where does she get the cash to pay it? Well, fortunately, the rules relating to S corps are clear that when you pay that dividend over to the trustee of the QSST, the trustee of the QSST doesn't have to distribute the fiduciary accounting income. The trustee can apply it for the benefit of the beneficiary, for example, by paying her income tax bill. That way, you're not going to lose eligibility for things like Medicaid. You're not going to be subjecting it to claims of creditors because the beneficiary will never have gotten the assets. And it's perfectly okay to pay for income taxes and still have the trust basically have the status of a supplemental needs trust. So this seems like a pretty good idea. What are you giving up by this? Well, what you're giving up, of course, is it's probably going to have to be paid over 5 years rather than 10. So you have to balance. Am I better off having this income attributable to the IRA or the plan taxed at the individual rates, but I get all the benefits of the trust, as opposed to having it taxed to the trust because I want it in trust. By premise, I'm going to keep this in trust because I want asset protection. I don't want the beneficiary to lose the entitlement to government benefits like Medicaid. So you'll have to balance those two. Is it worthwhile to subject it to the individual rates, but give up that extra 5 years of stretch? And that's something that you're just going to have to run the numbers on. But this is a pretty good plan, I think, where you really want it to be held in trust. You don't want the beneficiary to have it for spendthrift reasons or for government entitlement reasons. The QSST, being a shareholder of an S corp, which is the beneficiary of the IRA or the qualified plan, I think is something that is very worthwhile considering. Marty, let's summarize if we can.
Well, I'll give a quick overview, and then I think each of you should comment. So we started with an explanation of time value of money, compounding, and tax deferral is the foundation for everything that we then talked about. And then we built upon that by explaining what the Secure Act has done by, in most cases, eliminating the lifetime stretch with the exception for 5 EDBs. Surviving spouse gets life expectancy. A minor child of the plan holder gets life expectancy until age of majority, then 10 years, and the 10 years means the end of the 10th year following death. Disabled or chronically ill beneficiaries can get the stretch, and there is a lesser stretch available for a beneficiary that's, I forgot if it's 10 years or less than 10 years younger than the plan holder. So other than the 5 EDBs, we've lost the stretch. And so what we've done in this program is tried to give you 3 approaches to defer tax or get income from the IRA taxed at a lower rate. Richard talked about using charitable remainder trusts, and in particular NIMCRUTs, and I'll let him give a summary of that. I gave you a brief description of using a beneficiary deemed donor trust, or BDIT, so that the income of the trust would be taxed to the beneficiary at a lower rate, hopefully. And Jonathan gave a creative, somewhat off-the-wall, interesting idea of using a S corporation as a beneficiary held by a QSST, a qualified subchapter S trust. So why don't we turn it first to Matt, if you want to just give a quick summary of your talk, and then Richard and Jonathan.
Yeah, I'll keep my comments short. Thanks, Marty. I mean, as you know, we've talked about this whole presentation. The real goal here is how do we minimize, and ultimately, to the extent that we have minimized or can't minimize further, how do we postpone or avoid the tax for as long as possible? And these 3 ideas all come with different variables that will change with each planning situation, but also, as Marty mentioned, it really is worth running the numbers. There's a good chance tax rates will necessarily have to go up, and so even when the numbers are run, maybe looking at what a little bit higher tax rate might mean for these planning opportunities.
Rich? Your volume is off, Rich.
My apologies. So I think we stress the ability of a child remainder NIMCRUT to be a vehicle to stretch out IRA and plan distributions well beyond the 10-year period provided under the Secure Act, and that kind of stretch out, coupled with the potential to turn the trust into a spigot trust by placing the assets of the NIMCRUT into a partnership, whereby distributions could be deferred, and therefore tax would be deferred until much later on into the period of the NIMCRUT, thereby creating a long period during which income is earned but not taxed, which is an excellent benefit. I guess one thing to keep in mind is that with any charitable remainder trust, you're limited to taking out the percentage or the annuity, so that if there's a need more than the amount the charitable remainder trust is providing, you're not going to have access to it. So it's just one thing to keep in mind from a financial planning point of view, as opposed to a tax planning view.
Let me, Jonathan, before you get the last word, there's one point we didn't make, and it was probably my oversight. One of the other things you might look at doing, if let's say you're naming an accumulation trust, is shifting the situs of that trust to a no tax jurisdiction. So if you live in a high tax state like New York, New Jersey, Connecticut, California, et cetera, Massachusetts, you can shift that trust if you don't have situs assets, source income, and you have a trustee in a tax-friendly jurisdiction, and potentially defer state income tax, which could also be a significant savings. I should have mentioned that, and I didn't earlier. Jonathan, last word to you.
Well, again, let me say that all the ideas, the NIMCRUT, the 678 Trust, or the QSST, I think are worthy of consideration in some circumstances, not all. If you've got a surviving spouse, the most tax efficient thing to do is to have the spouse take it and roll it into his or her own IRA. That's going to give the maximum stretch. But again, you may not want your spouse to be able to have it outright, so that's a factor to consider. The price you pay for using the NIMCRUT, which is a very, very good idea, especially if your beneficiaries can afford to wait, is the price of the remainder. But again, in most circumstances, that additional 10 years of complete deferral will more than pay for that. But again, you can run the numbers. Second, the 678 Trust is worthwhile considering. But again, you're going to have to run the numbers and keep in mind that you are probably going to lose certain governmental benefits for at least 5 years. The QSST, I think, is a great idea for many, many people, especially if you do not have someone who's in a high state income tax situation. So if you have someone in Florida or Texas or Washington State or Alaska, that I think is perhaps a great thing to consider. But again, the price you pay for that is you have probably a 5-year payout rather than a 10-year, or if you have an eligible designated beneficiary, an even longer one. Now, one of the things that I've done, and this is the last point we have here, I've actually done some Excel spreadsheets to try to determine what is best. The problem is trying to guess what the tax system is going to look like in the future. That's very, very tough. The one thing I will guarantee, the tax regime in the United States will change over time. And I think most of us agree that probably over the next several years, rates are going to have to go up because of the cost of fighting the corona pandemic. Maybe they'll go down again. When I first started practicing, ordinary income was taxed at 70%. Capital gain was taxed at almost 50%. And if someone told me that before I've gone to my reward, it's going to be down to 37%, of course, you got that 3.8% net investment income tax. And by the way, that 3% net investment income tax doesn't apply to distributions from plans or IRAs. And in fact, if you flow it through a CRT or you flow it through a QSST, or a 678 Trust, you don't have to pay that. So that's a benefit of distribution. One of the things that we also should mention, if you do use a NIMCRUT, as Richard said, it's a bad income first, better income later. And all the IRA money or qualified plan money is going to be ordinary income. But if the trustee then takes the proceeds and invests, say, for long-term capital gain, then you're going to be paying tax at probably a 23.8% rate rather than at a 40% rate. So, or it could even be higher. But that's something to consider when you sit there and say, well, do we have something that we think we can get long-term capital gain for years 10 to 20, or when we take it out from years, say, year 1 to 20. So the only thing we have to pay ordinary income tax on is the IRA or plan distribution, but everything else is going to be taxed at a much lower rate. You can't do that with an IRA. As long as the IRA is outstanding, everything that comes out, even if it's experienced long-term capital gain or even tax-exempt income, comes out as ordinary income. So that, again, makes it more complicated. But if your investment advisors say, yeah, we think by and large we can get long-term capital gain, then again, I think that looking at something like a NIMCRUT is going to look pretty darn good. Marty, final word?
So just keep in mind, it's not a bad thing to give 10% to the charity. So Jonathan and Richard have both demonstrated that in a lot of cases, you're going to find that the tax deferral will more than pay for what goes to charity. But even if it doesn't, it's not a bad thing to give something to charity. And one of the things that we can all do in this very difficult time, where every charity that is dear to any of us is struggling with the economic turmoil and COVID implications to raise money, this is a great idea to take to all the charities that any of us are active in and try to use it to help charities raise more money. And keep in mind, even though charities need money today to run operations, if a charity gets a multi-million-dollar remainder interest in a CRT, they still get to announce that to all their donors It gets a lot of buzz going, and it's a great, wonderful thing to do. So let's not only use this to help clients, but we can use this to do some good in the world. I want to thank Matt Blattmacher, Richard Fox, and Jonathan Blattmacher for their wonderful input. I want to thank Peak Trust in Alaska and Interactive Legal for their sponsorship, and thank all of you for joining us. And just as a reminder, this program will be posted to shankmanlaw.com/webinars, and also to the Interactive and Peak websites. And Jonathan and I did a teaser. We did a 10-minute video clip that you can find on laweasy.com. And while we're being recorded, I'm asking Richard to join me and do a couple of clips on planning with CRTs for retirement plan assets. And I hope he says yes because he's on video. Say yes, Richard.
Sure. Yes.
Okay. Thank you. Thank you all for joining us. Take care, everybody, and stay safe.
Okay, thank you.
Thanks, everyone.